Hey everybody, this is Jose Blasco. We are about to start the session. It's 20 seconds to go, more or less. Let's use this time for a sound check. Please go ahead and confirm with a quick message on the chat box that you hear my voice. That will help me very much to understand it's all good technology-wise, and therefore we are ready to start. So please, quick message. Very nice. Thank you so much. How are you, Jill? Nice to have you with us in the session. Very good. We just reached the top of the hour, so it's time to maximize the introduction slide and have an official launch of the session so we can begin the planning and the trading. Here we go. Hello, everybody. How are you, everyone? Nice to join you today on February 19, 2020. Ready for longer term trading, isn't it? We're going to be utilizing options today, looking for opportunities that are directional to the upside or to the downside or both, and also opportunities that are non-directional, again, using options, okay? A quick look at the chat box. Pansy, nice to see you. Jill, hello again. Mario, very nice. Dirk, how are you? Perfect. Very nice. So let's begin. Okay, we always have a disclaimer. I'll read this quickly. So we start. Disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only, and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive when using our products. Here we go. Done. Session is now officially introduced, and here is our beautiful dress station. As I always say, with even more beautiful UFOs there flashing, and we are ready to analyze the markets and do some trading. Okay, I want to zoom in this portion of the screen where we have our scanner. Okay. And the reason why is because I want to point out the type of opportunities that we're going to utilize in today's session. We're going to be focusing on the bottom part of the table, okay? So basically you can see there 5 types of opportunities: directional to the upside, directional to the downside, purely non-directional, that's the meaning of ND, non-directional, and then directional with a little bias to the upside, and non-directional with a little bias to the downside. That's what we call neutral, because it's not purely directional like the ones above, okay? And because on the ones above we are purely directional, then those trades are debit trades, which is the meaning of DBT. And because the ones below is all about collecting premium and letting time pass, then those trades, neutral or non-directional, are going to be credit trades, all of them, as you can see here, okay? Now, we got 5 types of opportunities, but really what we normally do is we focus on the 3 from the top, isn't it? Let me do that again. Oh, I just went to the wrong place. Here we go. So, okay. Interesting. I just found out, I just discovered a new key combination on my keyboard. Okay. I don't understand why this is happening as we speak. Okay, got it now. So, sorry for that. But basically, what I was saying is that we have the directional long, directional short, and the neutral, which are the three opportunities from the top of this bottom table, which are going to be the bread and butter. So normally we look at the neutral trades on the bottom. We look at those trades are the type of trades that we look for, or the type of trades that we use if we don't find pure directional or pure non-directional. Okay, and why is that? Well, because when you do neutral trades, basically that's going to be credit spreads, and with credit spreads, you do collect premium, and it could be nice, but in most of the cases, the amount of premium collected will be less compared to the premium collected in an iron condor. So we normally give priority to finding setups for iron condors and execute those. Okay, and if we don't find it, then that's when we jump into those other trades which are neutral. Okay, very good. How are you, Charles? Good to see you. Okay, so let's begin. Okay, I've been running the scanner earlier. If you look at directional long, we got 8 opportunities that showed up. Directional short, we got 10, and non-directional, we got 8. Okay, so what I'm going to do is I'm going to start with the non-directional as always, and the first thing I would like to do is to click on the first one on the top after sorting those opportunities by the price points. This is Baidu. We are loading Baidu. It's a $134 stock. Okay, remember, the higher the price of the stock, the higher premium to be collected. And in that sense, it's a good beginning, isn't it? Now, my first impression with Baidu though is problematic because we got 42% probability stats, okay, with regular session data. So let's take a look at pre-post market, because remember, for non-directional trades, we need to at least have 48%. Okay, below 48, we don't take it. Okay, and in this case, we are borderline with 48, but we don't have 48, so we're not gonna make up a trade, and therefore we are just gonna move to the next one, which is low. So let's take a look at low. Okay, low, that, I mean, it's looking more powerful here with 54%. You can see it's a clear measurement of institutional interest, isn't it? A clear measurement of that. Okay, so 54%, that's what we got with pre-post market. If we look at regular session, it's 45%. So notice how for this company low, the real institutional interest is happening in the pre and post market session. Okay, so we may have an opportunity to work with this, but first, remember, there is always something that we are concerned about when it comes to looking at stocks with high premium, which is when are earnings going to take place. So what I'm doing here is I am loading low on TradingView, and I'm looking at the bottom part of the chart. Okay, I'm looking at the letter E that stands for earning. And if you look at it, it shows as next earnings are going to be on the 26th of February. So today is what? Well, today is 19. Okay, and when is the next Friday? Is on the 21st. Okay, it's 2 days and a half from now, something like that. And when is the next one? On the 28th. And remember, earnings we just saw is on the 26th. So what does that mean? It means that using the 21 is okay as an expiration date, but using the 28 would not be fine because the options would have not expired yet when earnings are reported on the 26th. And therefore, because earnings are normally a source of volatility, jumps in the market, gaps in the market, etc., so it would not be ideal to, I mean, it would be too risky, okay? Even though iron condors got a limited risk no matter what, because, you know, we are using 4 options at a time. From that end, the risk is controlled, but from a probability standpoint, that's what I meant to say when I said risky. Then the trade is not likely going to remain range bound, and therefore you're assuming risk, hoping that earnings are not too impactful, where normally earnings tend to be impactful. So we don't want to use, that's the bottom line, we don't want to use expiration dates happening after the earning dates. It's okay to use expiration dates that are happening prior to the earning dates. 21 is before 26, so then 21 is fine. Okay. So anyway, so looking at that, okay, let me zoom a little bit. Yeah, this is realistically is going to be a very difficult setup to make it work. So uh, mm, let me show you what my concern is, so you understand what I'm looking for, and also what I am not looking for, because what I'm certainly not looking for is to spend 20 minutes of our time planning the trade to conclude the trade is not valid. Okay, so I could certainly run the process normally, but in the end, even if the process tells me all good, take the trade, then if you look at the second UFO here, we always need two UFOs, isn't it? So the second UFO ends at 126, okay, 125.91. Let's call it 126. So what I want to do is very simple. Okay, I'm just going to look at low, LOW. Okay, this is low. And when looking at low, we're going to look at the 21st of February expiration date, and I'm going to look for the 126 and see how much I get paid, okay? And I get paid 15 cents. So directly, no need to spend more time on this one. We're going to discard it, okay? Why are we going to discard it? Well, we're going to discard it. Let me bring a document into the main screen. It's actually, now that I think about it, it's a long time I have not loaded this document on the main screen, guys. So just as a reminder, we have this document with plenty of notes of all the things that we've been doing in the get together sessions, sharpening, isn't it? And one of the things that we said is that when we sell options, we want 35. That's what we want. We want a minimum of 35 cents. We also said that there are cases where we'll take 25 if the other side of the condor was to pay more to offset the difference between 25 and 35. But the problem is that in this case, it's not even 25. In this case, the 126 is paying us 15 cents, which is certainly far away from the 35 that we're looking for, or at least the 25. Okay, so therefore, no need to look at the statistical range, no need to look at the charts deeper. Low is not providing an opportunity, and therefore we are going to pass. What else do we have? So we have IBB, that's an ETF, so we'll pass. Then we got XBI, that's an ETF, so we'll pass. Then we got HYG, that's an ETF, so we'll pass. Okay, so we got 3 ETFs in a row. The next one is EOG, and that is a stock. Then we got GILD, and then Delta Airlines. All of those are stocks. And we're going to go take a look to see if those stocks do meet our rules. So I'm loading EOG. For now, it's not looking good with 41%. But remember, I am still using pre and post market. So we always want to switch back to regular session to see if 41 becomes something else. In this case, more than 48. So EOG does provide us where the type of UFOs that we need for a potential trade setup. Okay. Having said that, there are other things that we need to check, and certainly the next one in the list, okay, and we cannot forget that is critical, is the earnings date. So let's take a look at EOG. So loading EOG, and we can see here earnings happening on the 28th. Okay, so the 28th, again, if you go back to the calendar, we saw it a minute ago, right? 28 is actually Friday. So again, we cannot use that Friday because then the earnings and the expiration will be happening more or less at the same time. And, this would not be recommended for a high probability trade. Okay, so what are we going to do? The only choice, the only opportunity we got here would be to use the 21st one more time. And again, this is what is the price of the stock? $75 stock. So it's not a very high price stock. So unless we got a lot of premium built in, those options, probably this trade will not work. Okay, but let's take a look, because if it does, certainly this trade will accumulate time decay at the speed of the light, given how close the expiration date is. Okay, it's only 2.5 days from now. Okay. So let's take a look. Okay, we are looking at 21 of February. Okay, 21 of February. We are looking at doing an Aron Condor. So I always say the same thing without even thinking about it. Just right click, analyze and sell. Interesting, it's not allowing me an Aron Condor here. Why is that? Analyze and sell an Aron Condor. Okay, and this will move data to the analysis tab. And here, what I will want to do, I don't really need to care much about the different options I have selected when it comes to the strike. The only thing I really need to make sure is that the date is right, because the moment I got this as a right date, and then I come here under pin and I change my plus minus 5% to plus 1 standard deviation and minus 1 standard deviation, given that particular date, now what TradeStation is going to do is to calculate what the statistical range should be given the expiration date. In other words, the current price of the stock is 75.10, which is right here. It seems that from now until expiration, that stock, at the speed at which it normally moves based on stats, that stock got potential to reach 78, and that stock got potential to reach 72.3 if the stock was to fall. So in other words, the statistical range where we will want to sell options above and below, okay, that statistical range is 78, 72.3. So keeping those values in mind, 78, 72.3, I'm just gonna throw a line out there where 78 is, okay? I'm just gonna throw a line where 70, was it 72.3, right? And 72.3, okay, so it's more or less here. And obviously there is no UFO at this price level, so I will need to go for the next one, which is right there, 71 something. And 78 actually is just a couple of cents, but hey, we are here to be mechanical, not to make up excuses. So 78, which is the value we saw on the calculator, is 2 cents above 77.98, and therefore the right location would be 80.8. So same question as before that I had with low. I am concerned that if I sell the 80 calls, I'm going to get paid nothing. So I don't want to put more time into this plan of the trade. The next thing I'm going to do is to check the 80 to see how much I get paid. And you can see I get paid absolutely nothing. Okay, so why? It's too far. It's way too far away from where the statistical range would suggest price should be trading in between. And therefore, of course, the markets that we trade are full of very smart people, and no one is selling those options for a higher price because price is not likely to get there. It's just that simple. Okay, so we don't have premium enough, and therefore we will pass on EOG, and therefore we move into GILD to see if that one will give us a trade or not. And GILD, so let's do that. Here we go. That, from an earning point of view, is a much better story because earnings took place on February 4. That's 10 days ago, something like that, where the next earnings are going to happen in April. Okay, so here we can certainly use multiple different expiration dates. So the question is, do we have a chart setup? So when it comes to chart setup, first of all, we do see good probabilities when using a regular session. What if I look at pre and post market? Pre and post market is also providing us with good probabilities. Okay, so if you look at the red UFOs, okay, I got one, and if I move to the regular session, that one UFO basically, okay, that one UFO is on top of this one. So even though we only see one UFO, really is like there are two. Okay, it's like there are two because you could combine the pre and post market with the regular session, given the fact that probabilities are both above 48. Okay, now careful, really careful here, because the current value for this particular stock is 62.52. Okay, and 62.52 is more or less here. So when the market opens, it's going to open gapping up here if everything stays the same for the next 14 minutes, since the market will open in 14 minutes. And if that's the case, I see a problem right now, which is the distance, the vertical distance between the upper line and the current price, and the vertical distance between the current price and the second green UFO, because we need two, it's totally in balance. We are way closer to the top than to the bottom, and that certainly it's problematic. Okay, so I'm gonna go ahead and take a look at the pre-post market session again to see. I don't think we had, but to see if we are lucky to have another green UFO, and we don't, meaning that the next green UFO we have is located all the way down here. So again, coming back to regular session, we are dealing with 65 and 62.83. So 62.83 is the value that we would use to sell puts below. right? And again, one more time, we are way closer to the top portion of the range compared to how far the bottom portion of the range is. Okay, so in other words, even if statistics and everything else is looking good for us, given so imbalanced, okay, I mean, in a perfect world, you want to start the trade somewhere in the middle of the range. That would be great, but we don't need to be that perfectionist. But again, the market is opening 0.73% up. So this thing is going to be up here, and certainly we are way too close to the upper part. And if you get stopped out on the upper part because the stock just runs, you will accumulate very tiny time decay only, and this trade is not going to allow you to do much with it, including some of the techniques that we have in the sharpening sessions when it comes to I forgot the term I use all the time. Utilizing the damage control mode. Here we go. Thank you very much for reminding this. So so here is my thought about GILD. Okay, and I'm gonna make a note when it comes to GILD. So when the market opens, we'll come back, take a look, because we may still have an opportunity. Okay, we don't see it yet, but my thought is that depending on the remaining price action that is left, that hasn't happened yet, in this time frame or the next time frame, we may have some new UFO show up at this price level. And if we were to have a UFO here and that UFO, then this particular UFO would now count as the second UFO. And then, if price is somewhere here, so now you are more or less equal distance with the top and the bottom. So basically, I'm expecting, or well, not really expecting, but I'm relying on a UFO to show up as the market opens. The app will tell us if there is an understanding from the app that unfilled orders are available at this price point, and if there is a UFO showing up, then we'll plan the trade right at the open. If not, then we will pass, because then the setup is not valid. Okay. Again, I kind of realized that I've taken a few things for granted. So let me say something that certainly is not needed to some of you, but for the ones of you joining these sessions since not too long ago, and maybe you didn't have the time to go over all the sharpening videos. So again, here I did take something a little bit for granted. So I want to phrase it so it's clear for everybody, which is that when we do non-directional trades, pure non-directional, like when we are building our own condors, so when we do that, we need to have at least two UFOs above red color and two UFOs below green color. That's why, I will not go for a trade, using this line and that line only, because then I only have one UFO to defend myself above and below. So again, to give ourselves a greater chance for price to remain between the UFOs and trade horizontally for a while, and last longer in that mode, the rule that we are utilizing is we need at least two UFOs, two above, two below. Okay, cool. Okay, so the last chart that we're gonna check, Delta Airlines. So same story, we'll look at the earnings while this is loading as well. So DAL. Okay, and what do we have? So the prior earnings in Delta Airlines took place in January 14. We don't see anything about it. Oh, actually, we do. It's hidden down here. Okay, so maybe I can. Here we go. Okay, you can see the E is right there. Okay, so the next earning is going to be in April. Okay, so Delta Airlines is certainly giving us a nice opportunity from the point of view of picking expiration dates, whatever works for us. Okay, so that's good. What is good as well with Delta Airlines, I mean, I cannot say yet because we're still having pending data, so we're gonna wait, but it does look like we got multiple UFOs above and below, so all of this is looking good. What is not so good though is that now we started dropping the price point of those stocks. It's the one in the bottom part of the list, so it's the cheapest stock on my list. And you know what happens, we talked about this many times, options derive their value from the underlying asset. The lower the price of the asset, the lower the price of the options. And what happens that when you do credit spreads and your intention is to capture as much premium as possible, so it's a weak starting point when the price of the stock is low, really low. And again, we all know, we covered that as well in the sharpening sessions, that the prices of the options derive from things other than simply the price of the stock. There is, expectation into the future movement. There is a time to expiration. The interest rates. There are multiple things that impact the prices of the options. We all know that, but certainly the one thing that is always there, it's that options derive their value from the underlying. So the higher the price of the stock, typically you get higher prices for the options as well. So that helps when you sell them. Okay. So a little concern with Delta Airlines to see if the trade is going to work or not. Okay. But again, let's go ahead and run the process. I'll run Delta Airlines and see what we've got. So probabilities when using regular session hours, 51.92. Probabilities when using pre-post market, it's under 48. So we will ignore that one. Okay, we will ignore that one. But when it comes to regular session, that is certainly those UFOs are certainly valid for us to lean against and rely on. Okay, so let's begin. I want to start with February 28 expiration. Okay, on Delta Airlines, and what I'm going to do with that is I'm going to go ahead and load an Iron Condor. Right click, analyze and sell. Iron Condor, this is gonna send me to the analysis tab. And from there, I got my plus 1 standard deviation, minus 1 standard deviation. So we are talking about 60.78, okay, and 56.56, okay? So almost 61. Okay, so almost 61 is more or less there. And 56.56, that is more or less here. Okay, so well, obviously, given what we have, okay, it's looking like beyond 56.56 will be 55.42, and also this helps to meet the rule of we need 2 UFOs on our end. So certainly selling the 55s, it's what we need to do. And then on the upper portion of this range, okay, would be utilizing 61.23, which is certainly above 60 point something that we saw earlier, 60.45. Okay, so the setup is valid. Notice as well that the opening price for Delta Airlines is actually below. Okay, so 58.42, it's somewhere here. Okay, so the price will start below, and if you look at the vertical distance from here to here and here to here, it certainly visually looks like more or less in the middle of the range. So all of this is quite, quite nice. So the real question now is, as before, okay, so how much I get paid if I sell the 61s? That's the question, okay? And notice, by the way, I always start from the top part because the top part is where we sell the calls, and the calls are normally cheaper price compared to the puts. So I'm looking first at my weakest spot, which is the upper part. And if the upper part works, then we got something to work with. Okay, and unfortunately, it doesn't. Okay, it doesn't work. We only get paid 13 cents. So the only way to get paid more would be to move out of February 28 into March 6. If we were to do that, now the 61 does pay 36 cents, and that is certainly now meeting the rules, right? So we can certainly use the 61 option if we use March 6. But the real question, and I'm back to the analysis tab, is, okay, wait a minute. This range from 60 to 56 is what would happen if we use February 28 expiration. If I give myself an extra week of time, for sure, that stock may move more. So how far more it will move? And the answer is very simple. You just click on it, 1, 2, 3. And now that you click on it, well, we got some errors because of missing strikes. So let me redo it using March 6, analyze and sell Iron Condor. And now it's telling you that the statistical range could be up to 61.90 and 55. And that is a problem. That is a problem because of 2 reasons. Because now, first, instead of 61, I will be using 62. And if I use 62, notice I will be paid only 20. And then on the chart, if I use 60, if I have to, give the stock breathing space until 61.90, that means that now I need to use that UFO, okay, which is okay on the bottom part. I may also use this UFO, that's fine. But again, this reinforces one more time the fact that you need to be using 62 point something. So March 6 bottom line doesn't work because selling the 62s would pay you less than 35, even less than 25. So then we can give it a try to see what happens if we use March 13. Okay, that's 23 days to expiration. Okay, and the 62, it's paying 34 cents. Okay, so as long as the later on we look at the put side and the put side pays enough. Remember, this is a bit below what we want. We're on 35. This is 34, but I guess we can overcome that as long as the puts pay enough. Okay, but again, the question is the same as before. If I use March 13, my statistical range from 61.90 to 55, it's not going to stay like that. It's going to be a bit wider. So how much more? Let's not guess. Let's just input March 13, 1, 2, 3. And now the range becomes 62.59 to 54.68. So basically, we are now not going to have enough with 62.23. Okay, we're not going to have enough. We will now need to go all the way to that 63.12. Okay. And if I do that, also in the bottom part, I need to at least rely on 54.68, okay, which is somewhere here. Therefore, I need to go at least and find that UFO at 53. Okay, so again, what if I sell the 63s? I'm gonna be very likely in the same situation. Okay, if I look at the 63s are paying me 20 cents one more time. Okay, so doesn't work. Therefore, we're going to look at the last one, which is March 20. And that one actually would be the best to do it from a liquidity standpoint because it's a monthly expiration date. I know because there is no word weekly. Okay. So that one is a monthly expiration and that one here too. Okay. So probably we get a bit better liquidity. Okay. The other thing we get as well is that we get 2.5 strike price increments. Okay. So this may be a bit problematic. Okay. So anyway, let's not anticipate. Let's just run the process in this case. So I'm just gonna right click to analyze and sell an iron condor. And this is now telling me 63.41 and 53.97. Okay, so the question is 63.91. It's above 63.12. Okay. Plus, I don't have the 63s on the option chain because the monthly got $2.5 strike price increments. I will need to use 65, and that is 12 cents. My friends, we're done. Okay, so it was looking like if the monthly had provided $1 strike price increments, it was really looking like we may had a way to make it work. But with the 2.5 strike price increments, that's it. Is not working. So why did I struggle in this trade? Well, because the starting point for the stock was 58. Okay. So again, we will find at times trades that are very valid with stocks of a lower price point. Actually, they give you a greater advantage because it means the value built in the options is even greater. Okay. The options are overpriced. Okay. And really overpriced. And that's nice. At the same time, most of the times it will require more time looking at the chart and basically saying no to that. Okay, so yeah, one last look. You know what? Now that the market open and it's updating, we may have a trade. Okay, because when using March 20, okay, and by the way, let me recheck the prior expiration date one very quick. So if I look at 63, yeah, that it will not work. 62 would be 40. Hey guys, because Delta Airlines is opening falling down, like almost 1% right at the open, I can see there is more premium kicking in those options. Okay, there is more higher pricing. So you know what? Let's do it again. I'm gonna go back down to the 13 of March. Actually, let me look at 61. 61 was not working. That's a fact. Looking at 6, 61. Okay, let's begin with the 6th. Let's see what happens. So analyze and sell an iron condor. That will give you a range of 61.5 to 55.11. So let's take a look. 61.5 would pay you 34, 62 pay you 18. So it's not good enough. Okay, so next one, March 13. So if I look at March 13, changing March 6 to March 13, and that is 62.29. So let's take a look at 62.29. It's still 63. So if we sell the 63s, how much we get paid? The 63s, we get paid 18. No, yeah. So last one, what about March 20? So right click, analyze and sell an iron condor using March 20. So using March 20, we're talking about 63. Okay, so we do have a valid 63 now, and 5380, 5380, which 5361 it's valid. So let's take a look at this. We may have a trade after all, and I may need to do something a bit complex here, so please bear with me. Okay, so if I want to do like exactly equal distance, I would go for that one. Okay, that would be very well centered in the range. That would be a perfect iron condor, 63 to 53. So now, how much I get paid for the 53s? I don't have 53s, I have 52 and a half, and they pay me 34. Okay, so maybe we can shave that a little bit. And then on the upper part, I got 62 and a half. Okay, that pays 33. Okay, so it's really, 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 really tight. Really, really, really tight. Okay, let's try. See what happens. So on the call side, we got 65 and 62 and a half. On the bottom part, we got 50 and 52 and a half. Okay, that would be the trade. And basically, my God, my friends, this is meeting the rules. Like exactly. Okay, so let me explain everything. Let me make a few notes on the chart, and we could take advantage of this acceleration of volatility with a 1% drop right at the open. Okay, and this we may need to rush a little bit here. So the iron condor will be made of buy calls above and sell calls above. Okay, and then all the way in the bottom part. Okay, then we're gonna go ahead and shrink this a little bit. We're gonna sell puts, okay, and buy puts below the puts we sell. Okay, so here we go, something like that. Here we go, that's better. Okay, so the calls are above, the puts are below, and obviously above we will want to use the 63, but it doesn't exist, so it's going to be 62.5, and therefore the one on top is going to be the 65. Okay, because we got 2.5 strike price increments. On the bottom part is more advantageous to manage risk because 52 and a half is below 53, so that's very nice, and then below 52 and a half is 50. Okay, so we're going to be doing that using March 2020 monthly expiration. Okay, the earnings again one more time were April 9, which is happening after March 20. I think it was March 20, correct? March 20, yes. So 20 March 20. Okay, that is the monthly expiration. Okay, so everything is good. Okay, so if we do an analysis of this trade, okay, and we input here in the option in the analysis tab the parameters I got on the chart, which is 62 and a half, 65 for the call side, and then for the put side, well, 52 and a half and 50. This is providing us with a 38 cents credit. Now, what is the risk in this trade? Well, the risk in this trade is the vertical distance between the strikes, which in both cases is $2.5. So $2.5, okay, is the most we will lose in the trade. What are our rules? Okay, our rules is that we need to produce a credit which is at least 15% of the difference between strikes. So how much is the difference between strikes? It's 2.5. How much is 15% of 2.5? Is 37.5 cents. And how much is the midpoint? 38. Okay, the midpoint is 38. So my friends, we are meeting the rules. What we are not meeting though, okay, is the fact that the 62 and a half should be 35. Well, now it was 35 a second ago. Now it's 34. And if it was to be 34, now it's 35. Back to 34. So if the 62 and a half now is 36, it doesn't want me to talk, isn't it? So if it was to be 34, okay, that means that the 52 and a half needs to be 36 to offset that problem, okay? But notice how we got 33 on one end, 35 on the other end. In other words, we are missing on 2 cents on the put side, okay? So that is a reason to not to take a trade, okay? But because it's only 2 cents, what I'm gonna propose to you is not to break the rule. We're not gonna break the rule, but what we're gonna do is to anticipate in case that happens, okay? So we're gonna use a day order. Okay, I'm gonna place an order here. We're gonna anticipate that the premium of those options are gonna inflate a little bit. This would only happen if Delta Airlines has a little bit of a aggressive move to the downside. Everybody gets scared. The options will get a little bit inflated, and a couple of cents is doable. So by default, you can see the midpoint is 38. Okay, the midpoint here is 38. So what I'm gonna do is I'm gonna go for 40. I'm gonna increase the midpoint to 40, because if I was to get filled at that price, somehow it's without me watching, I have managed to collect the extra 2 cents I don't have in the option chain. And for me to collect those 2 cents, only one thing needs to happen, which is that those options have to increase in value. So I could just, set an alert or something and just keep watching, and then run to place an order, or just go ahead and place an order with additional 2 cents. What could happen is that the day is over and you never got filled, because those options never gain those two additional cents we are looking for. But it could certainly happen, and then you will get filled automatically without you even looking. Okay, so I'm gonna go for that approach, where instead of looking at the midpoint, I'm gonna do something that in a normal case would 100% avoid you being filled, because I'm going for a better price than what the midpoint is, unless market makers are desperate to sell you those options. There's no way you're gonna get filled. But if later in the day Delta Airlines crashes, options gain value, then I'm gonna collect my additional 2 cents, and then I'm not missing or breaking any rule. Okay. So before I click place order, one more consideration which I have not discussed, which is critical: the quantity. As you can see here in the room, I'm using 1. That's my quantity. Quantity is 1. So that's what I'm gonna use. But remember, the risk of this trade, okay, and this is what you need to know for you to quantify your own risk. The risk of this trade is $250, because the distance between strikes is 2.5. Okay, and if you get filled at 40, right? So what's the most you can lose? Well, the most you can lose is 250 minus $40 you collected. So the most you can lose per contract is 210. In other words, think of your risk management rules. Let's say your account is $25,000. Let's say you have a risk management rule of 1% risk per trade. Okay, so that means that you are looking to risk 250. Because this trade has a risk of 210, how many options you sell, how many contracts, how much quantity? 1. Let's say your account is $50,000, okay, and you have the same policy of 1% risk. So 1% risk per trade is $500. So how many you use? Well, then you would come here, and of course it's common sense. You would just go for 2. So 2 minus 2 minus 2 plus 2, and now you would be taking double the risk in this trade. Okay, I'm just gonna go for 1, just to keep it equal to what I always do, so I don't get you confused. But all of you, please go ahead, have a proper decision about using real capital, paper money, and for sure, the size of your trades. I have it ready. Click place order. Here we got the confirmation. Yes, 1, 2. Oh, wait a minute. I almost made a mistake. Notice how I still got 38. I want 40, right? So place order, and notice they only, okay? So place order, yes, 1, 2, 3. Order is in. If I go check my manage tab, oh, interesting. My order should be there. It shows ascending. So for whatever reason, there is a little bit of a slowdown. Well, as you can see, I'm using a simulated account, and this sometimes happens. So there is a little bit of a delay. That's why it shows ascending instead of sent or received. So therefore, it doesn't show in the manage tab yet. Okay, so I guess it's a little bit of a temporary glitch. It's retrying the sending, so temporary glitch on the simulated account here. Today. Okay, things that could happen for sure. Anyway, so I haven't looked at the chat box for a while, so I'm gonna take a look at now. If you have any comment, any question, you guys let me know. Let me see. Jay, how are you, Jay? Jose, if you have a phone number for TradingView, I would appreciate it. If not, just let me know as soon as possible. Options at this stage is not for me. I'm not checking Forex first. Got it. Yeah. Well, Jay, we are not TradingView. We are Tradictive. So we don't have a phone number that we can share with you about TradingView, and also the policy or the style of trading when it comes to TradingView on how to take care of customer questions. It's normally online. So I believe they have a chat service or some sort of a messaging server on their website. And I'm sure if you click on the contact us, you will be able to find their email or something like that. Okay, but I don't know it by heart, so unfortunately I cannot answer that question now. Take a look at the TradingView website if that's okay. Dear Jose, we are too short on the call side for my taste. That was 10:37. Yeah, so I guess well, okay, Dirk. I am guessing, yeah, because we were meeting the rules here a minute ago, right? We saw 35 flashing. So based on the rules, it was meeting the rule, and therefore the trade is valid. When you refer to your taste, probably you have additional parameters or requirements for your trade to be valid to you. You may be more selective than me, and that's absolutely fantastic. Okay, it's certainly a better way to do it. Okay, so yeah, given the delta that you get, got it. I get you, Dirk. Absolutely. So again, we conducted sessions in the sharpening where I showed a specific way on how to do iron condors, and this is what I'm doing in the session. Okay, Dirk. Other variations on how to do it, I am not addressing it if you don't mind, because I don't know your rules, so I cannot comment. But certainly, Dirk, I know you well, my friend, and you are extremely experienced, and certainly your rules are making even better what we are constructing today, and it makes sense. Okay, so by the way, if you are more conservative and you ever plan a trade and none of them meet your rules, then you can now come back and rerun the scan after the market opens, and sometimes, not too often, but sometimes you'll get new opportunities show up, and then you can go check those other opportunities. Okay. Elen, you got filled at 41. Very nice, and nice for nice of you to share with us. Same for you, Mario. Very nice. Perfect. Yeah, yeah. I hear you. We're in the very same page, my friend. Very same page. Cool. Okay, so time to look into directional trades. So we'll begin with directional trades. And by the way, let me flash a little bit what's going on in the market. Okay, so this is not a market analysis session. This is a trading session. So we just look for opportunities that are tradable. Okay, we are not here to do market analysis commentary in the simulating being a market analyst, which is certainly very interesting information and very useful too. But this is not the purpose of today's session. But in any case, I want to look at this chart because it's a long time that I have not made a comment, which is important for you all to keep in mind, which is, again, coming back to sharpening sessions. In the past, we have conducted certain sharpening sessions where we've been talking and discussing about portfolio management and having a balanced portfolio, having the right quantity of delta so you can manage your risk, etc., etc. And all those decisions normally come out of what's going on in the broad market. And this is the broad market. So the broad market right now is dealing with candle number 10 in an up climate, which is supposed to last by 11 candles. So there is room for these to keep going a little more, okay? And then statistics suggest we're gonna have a climate like this, okay, where the market will correct. Corrections in this market are supposed to be 4 point something. In this case, it was more like 6 candles instead of 5. Again, it's statistics, but it's a good reference point. Is that making sense? So again, just keep in mind that even though every time I go through the lists that our scanners suggest, I will just plan all the trades like you guys need all the trades I plan. But certainly for the ones of you that already have portfolios where you run other trades in parallel, you certainly need to look at your at the portfolio Greeks and make sure that you are properly exposed to all those different Greeks, being delta a very critical one from a directional point of view. Okay, and if what I just said sounds a bit advanced or strange to you, it probably means that you haven't watched that session on the sharpening YouTube channel. So I would just go ahead and recommend you to go and take a look. Okay, you get into the sharpening and you look for that session on portfolio, and you will see what I mean. Okay, good. Okay, so this is what the market is giving us. Okay, so now same story. We're gonna sort those stocks from higher price point to lower price point. The one on the top is Netflix, and then we have Now. Those two stocks are actually pretty high price point, and to be honest, high price point means nothing, because if the trade setup is met, really the price of the underlying has no impact on the rules of the methodology, but it may have an impact when it comes to your risk management rules, because if the price of the stock is too high price, then the cost of the trade is going to be too high as well, because options derive their value from the asset. And then if you have let's say a 1% risk rule for risk management, well, that 1% risk rule may not allow you to take the trade because the cost of the trade is too much, because the price of the stock is too much. Okay, so I'm just, again, one more time, I'm going to go from top to bottom, but I would understand if some of you look at those stocks and it's like, wait a minute, that one is too expensive for me. Not because expensive is a meaningful word in trading. Actually, expensive means nothing. Because something expensive could become more expensive. So what's expensive? The question is it meeting your rules or not, right? Another way to say that is expensive is a subjective word. But again, it does have an impact in the risk management. Okay, so let's treat this opportunity like any other opportunity, and we are dealing with a climate that has been running for 18 candles, where stats suggest it's going to be 6. Well, I think that you are with me that if you enter Netflix now expecting it to double its value again, probably we are late to the party. Okay, so the climate is way too propagated, and could it keep going? Of course, we've seen crazier than that, isn't it? Is it likely? No, actually, it's not likely since a few candles already. But even though it kept going, anyway, what happens to Now? So Now have a similar scenario with 15 candles into the climate, where the climate is supposed to be 6. Okay, so very strange climate. And by the way, it was a tiny very minor pause and another crazy climate. So who knows what happened to this company? Probably a major fundamental element behind the scenes that created such a fantastic institutional interest, with 51% probabilities, which for stocks, that's pretty high, isn't it? For futures and forex, that would be a low value, but for stocks, being such a fragile asset, this is certainly very high. Okay, let me take a look at the chat box. I see Brandon Myers with a question. How are you, Brandon? So if price trades past either the short strikes, are you closing the trade and calculating stop loss? No, in the approach that we are running here in the session, we are not. And you could certainly go ahead and add additional risk management rules. Okay, but the approach, again, I'm just going to show it to you just in case. Okay, it's going to be a little bit of a way to give you all a little bit homework. Okay, so YouTube channel. Okay, so by the way, if you're enjoying the sessions, I never say it, I always forget, but if you're enjoying the sessions, just give us a thumbs up and subscribe and click on the bell and all those things that we do with the YouTube channels. Okay, so that way we are well connected. But again, going back to the sharpening playlist. Okay, so if I click on the view the full playlist, you have many sessions here. Okay, many sessions, and if I go down, where are you? So building iron condors is here. Okay, and then we got damage control here. Okay, so one simplistic way on how to use iron condors, it's to do nothing at all, meaning that an iron condor by definition has the risk limited by the long strike you purchase against the short strike, and because that's the case, the much you can lose is limited no matter what, and therefore if you were to do nothing, it's okay. Of course, there are other ways to manage risk where you could find ways to limit or make the size of the loss you were going to take to be lesser. And if you were to find a way to do that, that's certainly a great thing to do. Okay. Now, having said that, stop losses, which could you, some of you may be thinking, so that's it, let's use stop losses. Well, stop losses in the world of options, especially when you use strategies with 4 options at the time, such as an iron condor, stop losses are often the ingredient for a massive amount of slippage. And then, yes, you may end up losing a little less, but because you get killed on slippage, my question is, was it even worth it to do, right? So many cases it's not, okay? So one thing you could explore is to looking into how we build the iron condors here, and then maybe you can explore the damage control, which is how we take a failed iron condor and we butterfly it to give the iron condor a second chance, okay? And is it magic? Is it going to be save all your trades and next thing you know, you will never lose money in your life? Absolutely not. Trading, we all know, implies losing money at times. But could it reduce the size of your losses? Not always, but many times it will. Okay, especially if you started the iron condor with an expiration date that was not too close. When you get to butterfly it, at least you lock in some theta profits, and then when you butterfly it, you collect another set of theta, and all of this together does help to lower the pain of the trade, while you give the trade a second chance to actually end up as a profit instead of end up as a smaller loss. You may actually end up as a profit. So we call it damage control. Damage control means that there is damage. Okay, so it's what it is. It's not a magic formula. Okay, some people out there in the world of options talk about use terms such as repairing trades and things like that, which to me are a bit too optimistic, because repairing is kind of like you bring something broken into working, and it may give you the false impression that now you make money, and it's not the case. Okay, it's not the case at all. So damage control means, hey, let's try to mitigate the problem, given the fact that, if other things happen, maybe actually you end up with a profit. Okay, but it's a big maybe. It's not like a likely thing. It's a lesser probability situation, but at least you get the benefit of cut that loss short, which is what you would do with a stop if you didn't have slippage. Okay, so you may want to take a look at that, Brandon, if you haven't. Pansy, very good. Dirk, we discussed this butterfly and iron condor at our last options meetup. Great damage control too. Nice, very nice, Dirk. Very nice. Brandon Myers, good explanation. Thanks. I get it. Very nice. Perfect. I love it, guys. I love it that you guys are coming to me with very intelligent, smart questions, and it's beautiful to do this together, guys. So next one, Expedia. So what do we have? I want to accelerate a little bit here because we have 5 minutes. Okay, so at least I would like to find at least a directional trade. So with Expedia, we got 4 out of 7. So climate is fine. Probabilities are not. We need at least 50%. So what happens with the pre-post market? Expedia, give us something. Okay, so we got 49. Doesn't work. Next one. XLB, I'll skip it. Mendelez, it's almost always illiquid. So we'll go for Twitter. What do we have with Twitter? 10 candles out of 7. If you take 7, you take 8 and you add 50% on top of it, which is what we do. So that's 12. So 10 out of 12, we are still on time to take this trade. We just need to go with half of the size. So the question is, with Twitter, what are our probabilities? And the chart is still loading, okay? And probabilities with pre-post market is 47, which is not acceptable. With regular session, what do we have? We have 54%. Well, still pending data. So one sec. Pending data. Just waiting. Come on, Twitter. 1, 2, 3. Good. 52. Okay, that's nice. Okay, that's a powerful. There is institutional interest. The interest is during the regular market hours. And therefore, what do we want? Well, we want to wait for Twitter to drop, to come to this UFO. And when it comes there, would that be a good idea to buy? Yes. Why? Because the current value for the average is 3687, which falls nicely within that UFO. Okay, so we do have a setup with Twitter. What I need to find out with Twitter is I need to find out where my target would be. So I am turning on AutoUFOs on the daily time frame and maximize this. And the target with Twitter would be located at 4061, as you can see there. Okay, I'm guessing that you guys see that, right? So 4061. Okay, 4061. So knowing that our target will be 4061, okay, so the question is, what expiration date am I going to use? When are the earnings? Time to target? All those questions, right? So if my entry is the top of this UFO, which is 3703, okay? If my entry is 3703, oh, sorry for that. Here we go, 3703. And my target is 4061. So 4061 minus 3703, that is $1.09. So $1.09, if I look at the average true range on the daily time frame, which is $1.45 a day, so that means, I keep bringing the wrong calculator, that means that 1.09 divided by 1.4579, by the way, did I do this correctly? No, I didn't do this correctly. That makes no sense. Let me do that again. Sometimes, sometimes being mechanical is actually problematic, isn't it? So I was so mechanical, I was not even thinking. So 4061 is the target, minus 3703 cannot be one something. It has to be 3.58. Thank you. Now, this divided by the ATR, which is 145.79, okay? This is going to be 2.45 ATRs to get to the target. And remember, we give ourselves full weeks for an ATR, which a week is 7 days. So we need to give ourselves at least 17 days to allow this market to progress to the upside, the climate to keep propagating and reach the target at 4061. So 17 days is the expiration date duration that we need. So I'm loading Twitter, but also we also need to look at the earnings. Okay, so TWTR earnings for Twitter. When are they going to happen? So earnings for Twitter, they were reported here on the 6th of February. We don't have information about when the next earnings. Oh yes, they are right there. It's going to be 30th of April. Okay, 30th of April. So look, using March 13, it's enough based on the rule that we just saw. Okay, but at the same time, you're gonna give yourself enough time to reach the target, but you're gonna suffer massive time decay with the expiration date, because it's first very short, and second, we don't have anything that may help these options to regain some value. So what are we gonna do? Well, knowing that the earnings are on April 30, so my suggestion would be to use April 3, because you got more time to expiration, therefore less time decay. But on top of that, less theta, I should say. But on top of that, as time passes, if for whatever reason Twitter was to take its time to move to the target, well, then every day we are closer to earnings, and this will attract interest. People will buy the options, and if many people buy options, what happens to the price? They go back up, therefore fighting back a little bit the time decay built in them. So I'm just gonna right click to analyze and buy a vertical spread using April 3 expiration. Okay, and again, we just surpassed the time in which the session should be concluded. So I'm gonna do this quickly, guys. So moving this down, okay, so I'm visual, okay, so we have a target right there. So we have a target located at 4061, okay, so target is 4061, which is more or less here, okay. What do we need to do? Well, we need to sell calls beyond the target, okay, and we need to buy calls between entry and stop, and entry and target, okay, and that means that I need to find out what value that's going to be in a minute, okay. So the ones that would sell above, okay, well, you would think, okay, naturally I'm going to go for 41, okay, but we'll see. Let's begin with 41 and let's see what happened. And as I said, the expiration date that we're going to use is April 3, 2020, okay. That's going to be the expiration date to be used in this case. So let's go for it. Twitter, we got April 30. I'm going to start adjusting my upper unit to 41 because this is what I said. I also need to make sure I got two price slices which are adequate. One is going to be my target, 4061 above. The bottom one is going to be my entry, 3703. As you probably remember, that was the top of the green UFO band. So what am I going to do next? Well, I'm going to look at the deltas that we get at entry. And entry is 37. And what do we get? We get 14. Okay, and that's too little. Too little. We need at least 30. So I could move my 39 to 38. Okay, and that gives me 23. I can even move it to 37 and a half, and that gives me 28. But in both of the cases, I'm not achieving my 30 delta. So what's the problem? It's very simple. The 41, it's too close. So what am I going to do? I'm going to bring it up. Okay, and also for liquidity purposes, instead of 41.5, I'll move to 42 because normally round strike prices are going to be more liquid. Okay, so now how much I get paid for the 42? The 42 pays me 61. Okay, 61 cents. Okay, so it's good. It's fine. So I got the 42. Now if I do 42 and 37 and a half, I got 33 delta. That's a little over 30. So what I could do is go back to 38. Okay, and now no, it doesn't work. I thought it was going to work, but it doesn't. Now it gives me 28. So I would need to stick with the 37 and a half. Okay, so if I do that, it's not wrong. Okay, I do have my delta. I have positive gamma at entry, but I got negative delta at the target. And what is a better plan? Well, a better plan would be to attempt to have positive gamma all the time, no matter what. So how can I do that? Well, I can do that by bringing my upper unit higher to maybe 43. So now delta is -1. Now, of course, my delta now is 37. So what if I move it up to 38 now? So if I move it up to 38, now it's 32. It's a bit better, okay? But my gamma is still -0, okay? So maybe I'm gonna move it up to 38 and a half. Okay, and now I got a delta, which is not enough, and I got a gamma, which is -0 something. So I think that if I move this to 44, okay, I got a delta of 30, I got positive gamma, and I got positive gamma. So notice now, it seems a pretty smart setup where the delta at entry is adequate, okay, the delta at entry is adequate, but also the gamma stays positive no matter what, and therefore it's going to help the trade no matter what. So this is setup number one that I'm going to shrink and keep there using 38.5 and 43. Could be valid. The other option I want to try is just buy a call, just buy a call, okay? So analyze and buy a single call. And I want to compare those two next to each other, okay? Because if I buy a call, I buy the 38.5, I'm going to get 39. That's too much. What if I buy the 39? What if I buy the 40? What if I buy the 39 and a half? Well, the 39 and a half is giving me the delta I want. Okay, it's giving me the delta I want. It's giving me positive gamma, very, very highly positive gamma everywhere. Okay, and the question is how much the trade would cost me. So the trade would cost me $77 if I buy the call. And I'm being hurt at a rate of 169 per day, where if I do the spread, the trade is going to cost me more, and it's going to cost me $91 instead of 70 something, and I lose money at a rate of $1 a day. So losing at $1 a day and pay 91 versus losing 1.68 a day and paying 77. Okay. Well, the difference, it's not so much from 91 to 77. We're talking about $13. Okay. But the amount of pain on time passing, it's 68% additional. So I'm going to go with the spread in this particular case instead of going ahead and doing the simple call trade like we have done recently with markets making all times high. I'm just going to go ahead and do the spread in this case. So I'm just going to click trade. and I'm going to enter the order, and then I will conclude the session. I know I'm running late, guys. Sorry for that. So I'll make this day order. Remember, make sure you have the right size. You have $77 of risk per spread. So sorry, let me rephrase that. With the spread, you have $91 of risk, not 77. So each time you do a spread, you get $91 of risk. Okay, so make sure you adjust the right size, and then of course you will need an activation rule that has you buy that spread only if Twitter, okay, only if Twitter drops to 3703 or below. Okay, so less than or equal to 3703, okay, and then place order, and then we're gonna have a yes, 1, 2, and 3, and now the order will be in the system, and we should be able to see that here. Oh, actually, there is a problem on my simulated account, as you can see today. With again, the word sending is there, so it should show up here. I'm just having a tiny problem today. Okay. Anyway, so I look at your chat box very quick. I was just moving quite quickly right at the end, guys, rushing a little bit. Sorry for that, but I want to be respectful with your time. So we see that. Maria, how are you, Maria? Jose, at the end, could you do a review of the last week? Bristol Myers 70 call, April 17 for trade management purposes. Yes, absolutely. So good one, Maria. So with Bristol Myers, the trade basically did not much, isn't it? BMY. I'm not sure if I saved the parameters on the chart. I didn't save it. So I believe last week was the 12 or something like that. So price was probably up here. I'm speaking from my memory. You guys correct me, okay? And Bristol Myers went down, and at that price level, somewhere there, you bought the call, and from there, it went a little bit up and then a little bit down. And basically now, this trade should be showing a little bit of a red, isn't it? Let me see, because I think I do have it in the account. Yes, I have it in the account right here, okay? So I have this trade, 70 call, Bristol Myers, I got filled, and it shows a little bit of red, as expected, since time has passed, and on top of that, the stock has moved against us, okay? So what is the trade management to be done? At this point in time, nothing. Why? Because, you could certainly give yourself time stops, like what we do in futures or Forex. You can certainly, use a stop and conclude, hey, it went against me, I'm out. All of these could be valid trade management techniques that, if those are your roles, it makes sense and it's fine for you to implement. But my approach, okay, the green UFO was 65 and 66.77. So 66.77, it's more or less here. Yeah. So then we got in around that price level. Okay, that's where we got in. Okay, got it. So again, what I was saying is that my approach when we get together here in the room is to try to keep it as simple as possible. And one of the benefits of buying a call is that the most you can lose is what you pay for the call. Therefore, if you were not to use stops, and let's say Bristol Myers just falls and falls and falls, or Bristol Myers doesn't fall, but sticks here forever, and then you got the expiration date and Bristol Myers is still there, then what happens? Well, you lost the whole amount you would pay for the call. So if it goes against you or does nothing, the most you will lose is what you pay for the call. Okay? And that's great, because what could happen, okay, like for example, if you look at this move down, okay, so let's say you had a move up like that, like this one, right? And next thing you know, you got a retracement and you purchase Bristol Myers here, and now it's moving your way, and you're like, great, and suddenly it goes against you, and you're like, oh my god, let me get myself stopped out here. So you get out of the trade here, and then what? Now you're back in business, but you missed it because you took yourself out of the trade. So what's the beauty of using calls and not using stops? Well, now Bristol Myers may fall, hit that green UFO, come back, create new UFOs, and now next thing you know, you start making all times high, and next thing you know, we have a beautiful trade. We have seen many trades like that happen in our account last year, isn't it? Therefore, at this moment in time, the stock has been moving against you, and therefore, the right action to be taken based on my suggestions, based on the rules that we have here in the room, it's basically do nothing. Okay, so Maria, nice that you are asking me to review this trade. I love it. It shows great commitment, engagement from your end, etc., etc. But at the same time, I have very little to share in this case because this is the time where there is absolutely nothing to be done. Different story is that now, Bristol Myers starts moving back up, okay, creates new UFOs, keeps moving more, etc., etc. Okay, and now you are in a net profit situation. So now you may want to utilize those UFOs for stopping purposes. So if it goes below those UFOs, get out, because if you get out here, you'll collect a little bit of a profit. It's really disappointing. But if you got multiple UFOs, and this is supposed to be, now notice the climate is changing, right? But if Bristol Myers goes back up, probably here is gonna flash blue. So if the climate is blue, but you start going through UFOs, probably you're gonna go from blue to red again. And what would you do? Well, it would be smarter to collect a small profit at that time and wait for the same setup to replicate and re-enter Bristol Myers sometime in the future and keep riding it. But at that moment in time, you would just collect that profit, and that would be a nice trade management. But this does imply Bristol Myers moving your way and give you UFOs, which is not what happened. Up to this point, Bristol Myers has only done one thing, which is to react to what the market has done, basically. Not today, though, because the market today was up and Bristol Myers is down. But basically, the prior days, the market, did experience some speed to the downside, and that stock did too. Okay, so really long way to answer your question, Maria. But basically, nothing to be done. Just stick with the trade. You have your risk under control. The most you can lose is what you pay for the call. So stick with it. If the market pushes, if Bristol Myers restart a new climate to the upside, you'll be in the game, and that trade that is currently losing $23 per call will be back to green. Anyway, everybody, super pleasure to be here with you guys. We'll see you soon. Bye bye. See you next week. Take care, everybody. Keep up the good work, okay? And if you have any question, of course, we are around. Take care. Bye bye.